Hey, it's Michael Saul, but everybody calls me Tiny. This video is get ready for the next leg down. This is stock market analysis for the week of October 22nd, 2018. If you would like to receive intra-week updates, go to www.attackthemarkets.com, put in your first name, your best email address, follow the directions, and you will be on the distribution list. The Facebook group is at facebook.com/groups/attackthemarkets. If you like what you're hearing, give me a thumbs up and leave a comment so I move up the ranks in YouTube. That would be awesome. And if you never want to miss a video when one is updated, click subscribe and smash that bell so you'll be notified. Okay, going to be a short video today because while I don't have a lot to say as far as length, there is a lot of information in that in my truncated update today. All right, so let's first of all, I want to apologize for all these lines all over this chart. I hate looking at charts with tons of lines on them. I mean, I do have a trend line fetish, but this is a little bit crazy. But this line here is just connecting the Fibonacci grid from the lows of the year to the highs of the year. That's all that this line is doing. So it's not really a trend line. These lines are just measuring small pullbacks. And this big line is measuring a symmetrical move that would be equal to the dump in January or February. I still think that's where we're going. This is what the chart pattern is telling me. All right, so after we hit the new highs on the Dow, and I know I'm looking at the S&P 500, but once the Dow hit the new highs, it was a sign of work done. Now, I don't think we've entered a bear market or a huge correction, but we are obviously in a correction / pullback, whatever you want to call it. Okay, and really, I mean, it's not semantics. There is a difference between a pullback and a correction, but for our purposes, let's call it a correction for now. Okay, because so far it's the second biggest pullback, probably. I don't know, maybe this one was, whatever it is. It's either the second or third biggest pullback of 2018, and I think it's going to be at least the same as the largest pullback of 2018. So we had the little rumble to the downside here. That was about 2 weeks ago. Then we did get a bounce last week, but it fizzled out, and now we are in a coil here. I would love to call it a bear pennant, but it's not, because all in all, it's in the range here. But it does look like there's a very good chance, because of the failure to continue to the upside, that we will go to the downside. Of course, I'm going to look at both sides of it, but I believe we're going to see another leg down. I think we're getting at a minimum to the 61.8% retracement, which is 268.70 around that. I may be off by a couple of ticks depending. It's irrelevant, right? The exact numbers are irrelevant, and that's on the SPY, right? The zone is more important. But I really think we're going lower. I think we're going to the 78.6% retracement, and perhaps the full measured move, which would be at 260 at a minimum. Now, if we break through that 260, then I would be looking for new lows on the year. Right now, I'm not calling that as a probability right now. I do have a high agreement in that we're going to go lower. But for me, and this is what one of my mentors taught me many years ago, I only like to commit. I mean, unless it's a strong, like a flag or a pennant or a follow-through day, which we're not seeing here, obviously, I like to commit about 70 to 72% to a move. I don't like to be 100% all in to something that there's really not a bias for. And the reason that I can't be biased here is because we're more just stuck in all this girth. And this, I mean, talk about trend lines, I deleted these, but I'll pull them back here. You know, this balance area here from this pattern, this could hold us up as well, all right, because there was a lot of work done here before we popped out to new highs. So while I do favor the downside here, I have to look at the other side, which is this coil, which is right on the 200-day moving average. Okay, it's holding the 200-day buyers come in, and then we pop up. Now, you can give all the excuses you want about geopolitical this and President Trump that and what's going on here and trade wars and rates and everything. I'm looking at just the charts here. All right, because the news, right, first of all, the market climbs the wall of worry. So if you want to talk about bad news, you can easily flip it to, hey, the market should be going higher here. But if you want to look for excuses for bad news, there's plenty of them. There's plenty of reasons why we should pull back. Okay, I'm looking at the technical view here. So here is what I'm thinking, just to wrap this up, and really, it's going to be this quick this week, okay? I believe we are going lower. I am going to be watching for Friday's lows to be taken out as a trigger. I think we're going to the 62% retracement at a minimum. The 78.6% is, in my opinion, has good probability. Again, I am wrong if we come out the upside of the pennant, and but I'm not going to get trapped there because I'm waiting for the trigger. How I get trapped is if we trigger off down first, and how a lot of people get trapped, right? And then that's the trap, is if we come down first and then go higher. If we just go higher from here, that's not a trap. Unless you're positioned inside the pennant, which, in my opinion, inside the coil, I should say, right? Pennant has a directional bias, so we'll call this a coil. Unless you're taking, say, you know what, I think we're going lower, let's just get in now. Then you can get trapped if it goes opposite. But if you're waiting for confirmation, you only get trapped if it confirms and then goes. It's important. And yeah, it's a little bit of a quote-unquote wimpier way to play, but I don't understand. I mean, why do you want to be a hero? It doesn't make any sense. I would much rather wait for confirmation. I would much rather get in a little late, but be more certain that it's going in my direction, because you're never going to be 100% sure, because it can always turn tail and go. But I'd like to get confirmation that I'm correct and miss a little bit of the move. I mean, come on. All right, let's go through the other indexes real quick. Dow has a similar pattern, but it's above the 200-day moving average. NASDAQ, same kind of deal. The Russell, the Russell looks like it's going down to the 78.6 sooner rather than later. Same with the mid-caps. All right, let's look at a couple of sectors. Here, you see the semiconductors. The semiconductors look like they want to come to the 2018 low. And then if they break here, next line in the sand is down here at about 1100. All right, the banks, banks not looking good either. So the financials are definitely putting some pressure on the broad market. You got support down here in the 96s. And then you got the broker-dealer. Okay, looks like a possible little small continuation pattern. I mean, not technically not a continuation pattern, a stealth continuation pattern, I call it, because there's really no impulse here. Looks like it could go lower as well. Biotechs, watch the 200-day moving average. They were one of the strongest sectors. They got smacked with the ugly stick along with the rest of the market, so watch the 200-day moving average. Gold, gold trying to get a rally going here. Again, I didn't see this rally coming. I still am not 100% sold that a bottom is in, but I want to watch the next pullback. If that holds up strong, then gold could be putting in a short-term bottom here. Oil, right on the 50-day moving average, back inside this balance here. If it continues lower, watch the 200-day moving average. And, of course, bonds, I still think are going lower, which means rates will rise, and that will put continued pressure on the market. Questions, Tiny at attackthemarkets.com. Sign up for intra-week updates so you can stay informed during the week. All right? I will talk to you in the intra-week update or in next week's video.